locked in to the Cash Flow Show with Dave and Nate, the best place to navigate how to achieve capital appreciation with commercial acquisitions. Here's your hosts, Dave SEYMOUR.
Hey, we're here. Welcome to the Cash Flow Show. And, and we got Dave on audio. We're zooming him in. Where are you from? Where are you, Dave? We miss you.
I'm in the bathroom. Hold on a minute.
Okay. The microphone on. Well, you know what it is?
I hate when this. You can't see it. Watch magic.
What?
See?
Oh yeah, it's one of those.
Yeah, it's one of those.
This would give me that time, to do my thing. I always do my thing. See, while you were getting your water,
I'm gonna have a drink.
Yeah, if you drink, I'll do my thing. Everybody, welcome to the Cash Flow Show. This is your host, Dave SEYMOUR and Nathan Amaral. Thanks so much for tuning in. If you'd like to start off by saying hello in the comment section, that would be great. We'd like to say hello back. And if you're new here, let us know that it's your first time or if you're new. If you're a virgin to the show. Good stuff. Now, Dave, you're at a new extraordinary location. I see. It's like your office is expanding.
I am. I'm at a new secret location. It's top secret. Okay. It's I'm in the bunker with Sleepy Joe Biden right now. And no, I'm at home.
Oh, see? There it is. Wait. So if you're at home, Mary Beth can just pop in now instead of watching remotely, right?
Yeah. So don't say anything about bad parental habits.
No, I won't do that. Yeah, I won't do
that. I came in the house like Hurricane David, throwing stuff around. The internet office crapped out, and I couldn't find my pods, so I got Mary Beth's pods. And I'm all flustered, Nate. I'm all flustered.
Why are you all flustered? What's going on?
It's gonna be.
I know. I gotta fix my. We're both wearing black today.
Yeah. But I don't have the Nike swoosh.
I'm always with the swoosh, but I hate when my undershirt comes up. I hate that. It's so annoying.
I hate it when my underwear comes up.
It does.
And it's like you're doing that mall wedgie walk.
Yeah, you're gonna like.
Falling, shake your legs. I heard that
What?
Tommy John's underwear will fix that problem for you. That's what I saw on a commercial.
Did you? Wait.
You're not. Are you wearing Tommy John's? They're the most comfortable underwear.
No, but listen, there's a new one.
I don't wear yours. I wear mine.
There's a new one that came out. I did get 2 pairs of Tommy John one time, and they were okay.
Expensive.
It's super expensive. There's a new one out there now called Beneath. Check them out, man. They're okay. My friend, I can't get them yet because of COVID. They can't ship here right now, but they're really good. I hear they're really good.
Really? I have my COVID test, by the way.
No. Oh, that's right. Because you were flying. How'd it go?
I went out of state. So you want to hear something funny? What's this one, right? So I got to go to Florida and back. Yeah. As I told you before. Yeah. We shot a nice infomercial with Kevin Harrington, poolside, right?
Yeah.
Doing that thing. It was great. Had a little dinner, did a little more meetings, looked at some more properties, get on a plane, come home.
Yeah.
Well, Charlie Baker decides that now if you're inbound to Massachusetts, you either have to have a negative test within, I think it's 72 hours of coming into the state, or you got to self-quarantine for 14 days.
Ooh.
So, look, Mary Beth says to me, she says, are you going to self-quarantine because you didn't get a test in Florida?
Yeah.
I go, look, honey, I don't know. I'm probably, I don't know. Like my patience with this shit is really dim right now, right? So she says, straight up, she says to me, if you don't, if she's listening upstairs, she's probably going to come down and smack me. She goes, if you don't self-quarantine, they could FaceTime you.
FaceTime you?
Yeah, FaceTime you. I go, who's going to FaceTime me? She goes, well, they are.
Who's they?
I know.
Wait, who's they?
Frickin' Charlie Baker. I said, why are they going to FaceTime you? Make sure you're at home.
No way.
I said, yes, that's what she said. I said, sweetie, you've been following way too much shit on social media, number one. And number two, if it is real and they do FaceTime me, I promise you I'm going to not answer until I get my butt sitting on a toilet, and then I'm going to answer it. Hey, Charlie, how are you?
Charlie, what's up? Yeah, no, I don't think they're doing that. Are they?
No,
FaceTime?
I
No.
don't know. I saw it on social media. It must be true. So what I did was I didn't want to upset my beautiful wife any more than I needed to. Your
Yeah.
Tommy Johns are poking out right there.
Yeah.
You good? All right.
Yeah. Yeah.
I don't want to upset my beautiful wife any more than I had to.
Yeah.
So I said, if you arrange for me to get a COVID test, now I'm home, I'll go take one. So I got home, I don't know, Friday, whatever it was,
All
and
right.
I get my COVID. She lines me up for a COVID test Saturday morning, and I got to go in
Oh.
line with these cars. Like I went to one place, and there's all these wallies standing around with masks on, all like,
Okay.
I'm gonna get my COVID test. So yeah, I'm sorry. I got no filter today. Watch out, not at all. And so I go to a drive-through,
Yeah.
and it takes me an hour to get from the back of the line to the front of the line. And then when I get to the front of the line, the super nurse, really nice guy, he's got his mask on. And as I pull up, he goes, "You." He goes, "We need a rehab at my house. You." I'm like,
We need to rehab at my
I'm like,
house.
I said, "No, you're confusing me with Dog the Bounty Hunter." He goes, "No, I know you. You're the Tim Flipping guy." I go,
Uh,
"Yeah, I guess so."
uh,
So he takes down my information. I just said to him, "Here's a 20 spot." He goes, "What's that for?"
mm.
I said, "To buy me a negative test." He goes, "What?" Yes, I saw it on the internet. He goes, "No." I go, "I'm only joking. Buy pizza for you and the other nurses. I appreciate you guys being out here, right?"
Yeah.
So I cuff him a 20 spot. I get some pizzas. Anyway, then she shows up with this Q-tip, this swab,
Oh, whoa, whoa, whoa.
that long,
No
right?
way.
And she says, "Okay," and she starts shoving it up my nose,
Oh
right?
my gosh.
Gently placing it, shoveling it, and then she gets a hammer and she starts banging it up
No
my nose.
way.
What it felt like.
Oh
She
my
shoves it on my,
God.
and anyway, she does the thing. Now my eyes are watering. I got
Oh,
ringing in my ears,
oh my God.
and I just said to her, I said, "I think I would have preferred, the finger that the doctor gives me than that." I said that was more more pain. I'm serious. Would have. I think I would have. Oh my heavens! And then I just drive out of there.
Oh
Ruined my
wow. Is
ruined
it
my
that
whole.
bad? Does it really feel that bad?
Well, I've got like a little something going on up my nose, so I don't know. It doesn't always go in a straight line. I've never been much of a conformist.
Okay.
You know what I mean? Get to go up and around the corner and
Oh
whatever she
my.
go. And I'm thinking I'm going to get a nosebleed out of the thing. But
Oh
anyway,
my God.
the results came back. The results came back. I'm
Mm.
positive for heroin, cocaine, methamphetamines, and oxycontin, but I'm negative on COVID.
Oh,
So we're
that's
good. All right.
fantastic. That needs an applause. That needs an applause.
Well, it's getting a little crazy out there,
Oh my
Nate.
goodness.
It's getting a little crazy out there.
That is
Florida
crazy.
was good. Yeah, we had a good time. We did some good stuff.
Yeah,
It
it
was
ended up
good.
going well. And that turned into positive results, right? The Kevin Harrington partnership in
Yeah,
yeah.
yeah. I had a great conversation today with a gentleman who runs a company called
Hmm.
FamilyOffice.com, I think it is, or privateequity.com.
Oh, yeah, okay. The guy with the
Yeah,
YouTube channel.
yeah, he's got a YouTube channel.
Yeah, yeah. Okay.
I had a good conversation with him today,
Yeah.
fleshing out some ways to, get our fund in front of some family offices. And it was interesting because he said something that we'd already experienced was there's a challenge raising money when the investor can't see exactly which property the money is going on.
Mm,
So in a fund, right, we have multiple properties. Like we've got
right.
1, 2, 3, maybe 4 properties ready to go right now.
Okay.
It's like the investor comes in, looks at it, and says, "Well, I'm going to move $500,000, $250,000 from my IRA or from the stock market or from just cash in the bank,"
Right.
but they're still having a tough time wrapping their head around. No, you're buying into a company
Mm.
that owns all of these, not
Oh,
just you're
not
not
just
just on
one
one
unit.
of them.
Yeah.
So it's a different fundraise. I mean, my partner Walter Nathan, he's raised in his career about $250 million in private money
Wow.
to buy multifamily assets.
Wow.
So he's raised $250 million,
Yeah.
deployed $250 million, actually spent it, which is what you need to do to get it to grow,
Right,
right?
right. Yeah.
Plant the seed,
Exactly.
and paid it back.
That's the important thing.
right, with north of 20% returns.
That's insane. That's
So
great.
it's so now it's like, well, why isn't the money coming as fast as it has in the past? Well, it's just a different structure or a model altogether. So it's kind of interesting.
Yeah.
It's good. It's exciting.
Yeah, but these are, and I think a lot of investors are turning into more of this option, right? Because now we're seeing, hey, but wait a second, did you test negative or positive for COVID?
I tested positive for cocaine, heroin, marijuana.
Wait, I got that.
Methamphetamines, negative for COVID.
All right, yeah. Okay, someone's over here asking. Maybe they missed that part. Sorry, that was like a rewind.
I added marijuana this time.
You added marijuana this time, yeah, that's true. A lot of people are making switches, like we're seeing in office space, right? Just completely declining. Big companies making the big shift in working remote work. And then, interesting enough, I don't know if you heard this news, but I believe the number is 1.4 billion off the top of my head. I've been hearing a lot of numbers recently, so I believe the number is 1.4 billion. Became an opportunity for Amazon to secure downtown retail. Yeah, I'm going to call it retail, to create as fulfillment centers, right? So that's huge. This has been a big opportunity for companies like Amazon or fulfillment companies per se, to get into the downtown markets now with a lot of leases coming due. But this has had a major impact on the outskirts, I'm going to call them the old-fashioned shopping mall, even though, because I mean, the reality is you can get everything pretty much at a shopping mall. You can get right online, right? I mean, that's what it's all about.
It's devastated, absolutely devastated them. I heard that same investment strategy or storyline as you did. Yeah. That a lot of these, the Main Street's either gonna, come back reconfigured. Like if you take the town in which I live, for example, they have passed a city ordinance that allows for that downtown, Main Street retail to be able to be expanded to allow for residential above. So kind of like the, a walk up, that kind of concept, or in New York, they call them a taxpayer, the stores downstairs, apartments upstairs.
Right.
So a lot of these storefronts, they're allowing them to expand up to put in residential apartment houses. So it's interesting to see how well they pivot. But here's the challenge, Nate. How much capital and how much losses they're going to be to the investor marketplace. Absolutely. For those that, are rolling the dice, for example, or they've already invested in it. Well, and that's the challenge.
Yeah, and that goes back to the point I was making, is that, a lot of investors have invested in office spaces and in retail. But again, a sure bet at the end of the day, because people now are not walking into retail stores to go buy those things, but guess what? They still walk in their door at home at night, right? So they go back to their apartments. They go back home. For sure. So that's why it makes it much more of a safe bet for apartments, because of the market conditions. And even in growing markets, I think you said last time on the last week's show, you talked about growth markets, and I think you said some of the properties that you're picking up are in more of these growth markets where people are relocating there. Path to progress. There's a lot of more growth in those markets. Can you shed a little bit of light on that part of it, of like where in those type of markets that you're picking up properties?
Yeah. I'll give you an example of what's going on. Now, we're not picking up properties in this particular market, but the underlying driver is in the markets that we're in. If you pay attention, I think it was New York City right now has 18,000 more vacant apartments than they had this time last year. Yeah. And what's that done is it's simply increased the demand for rental units and apartments in Connecticut. Right. They all got out of the city. So Connecticut's seeing a huge bump in that demand but they're still very compressed in their capitalization rates in those markets. So they don't necessarily cash flow as well as an asset does that qualifies for our fund. So with us, we look at the what are called the secondary and the tertiary markets outside of what are called the MSAs, which are the large metropolitan areas.
Right.
So Tampa, for example, and that swath of Florida where we focus, we see that same demand because they're still moving to Florida in droves, man. They're still moving in droves down to Florida, and we're just following that path.
Yeah, and actually, so going back to what you said about, outside of the MSA, there's been so much because of COVID. There's been so many people that have decided to move out of, whether it's New York or any downtown area, right? So they're now moving into these suburb areas to live. And that's where a lot of these bigger, shopping malls are. More people are moving to those areas. So rentals are going to go through the roof.
We got a property on the acquisition block right now. I think we're going to move forward on it. It's a very nice asset, and the long story short of it is it's just outside of where Mickey Mouse lives, and we'll just leave it at that because I can't give you the exact town, but it's close to Mickey's house.
Okay.
And it's an A plus asset, which is interesting because we focus primarily on B class assets. So it's an A class asset. And it is 100% not occupied, 100% empty. And the reason is it's 60 units.
Okay. And
they have gone through a bankruptcy. So because of that.
So they have to get out.
Right. They're all out.
Yeah.
It was never occupied. It's never had anybody live in it.
Yeah.
It's 100% complete. It's now gone through bankruptcy because of other assets that this builder had that did go belly up because he didn't know what he was doing, and this is just part of it.
Okay.
But the interesting thing is we did a rental study to make sure it qualified, like the demand was there.
Yeah.
And the rental study, which is third party disinterested, no slant.
Right.
Like BBC News. It's not Fox News.
That's a great reference for
much.
sure. Absolutely.
I just pulled that right out of my political rear end.
That's like the only news I go to. Like this is BBC, man. You just go to BBC.
Let's go to BBC, and it's got a cute English accent.
Exactly.
So we got a third party give us a rental study,
right?
And they said because this particular asset had 3 bed, 2 baths, they said that more than 50% of that facility would demand lease up in 30 days.
Yeah,
think about that. So you buy based on actual numbers. Well, if there's no income, then it's not worth anything. So you got to buy it based on. So the NOI on that thing is like 120% increase right off the bat 30 days later.
How complete is the building?
100%.
Oh, score.
Brand spanking. Thank you very much.
Score.
I'm glad you appreciate that.
Oh, yeah. Well, I do because I'm in a similar situation, but not 100%. But the property that these 26 units I purchased were about, let's just say 50, okay? 60, 50, something like that. Probably more like 60. So floors were in, marble. Countertops done. I mean, it was just, granite. We got a whole bunch of stuff. Doors, everything, okay? So let's just say 60% finished. And the beauty about that is that it's out of bankruptcy. And you're basically picking up, I mean, they went all in on the foundation. Like this structure is so solid, you can't smell mold, mildew, any form of moof smell, right? And it's been sitting for 10 years. That's how strong industrial strength this property is. Yeah. So the opportunity to buy out of bankruptcy is a very powerful situation. And it reminds me of, and I'm not trying to get political. I'm going to go BBC on you right now, okay? But President Trump, years before he was president, was doing an interview with David Letterman. And he made a very powerful statement that always stuck in my mind. And Letterman was saying, Mr. Trump, how did you get the Mar-a-Lago? Right? And he said, how'd you get, well, he's like, oh, well, I know a few people, right? I have some friends, And they called me. He's like, I wasn't looking for the Mar-a-Lago. They called me. I have a few friends, and he makes a comment and he says, and these friends, if you owe them money, they'll do some bad things to you, right? So immediately I'm thinking, all right, these must be debt collectors. Anyway, so Trump's buddy calls Trump and says, hey, I got the Mar-a-Lago, right? And if you buy it for X pennies on the dollar, it's yours.
Yeah.
So that was buying bad debt. And sometimes some of these great deals are either in bankruptcy or, whether it's private or commercial or, the reality is those are some great deals. It sounds like to me, you have a score of a deal, especially at being 100% finished, ready to go.
There's no work to be done. And what they've done is the bankruptcy court insisted that they maintain the property. So it's Florida. Guess what? The grass is still green.
Of course.
Right? The water is still flowing. The AC is
everything's still on. Yeah.
It's still on. Everything's there. So that's absolutely huge. I mean, look, to your point, Nathan, it's not what you know, it's who you know. And then if you got the right who you know and you know what you're doing, then you can execute on the plan.
Absolutely.
Right? That's when the what you know comes in. You got to know what you're doing once you get in that game afterwards. So
exactly.
Having that direct to seller, that direct to bankruptcy relationship is a huge piece.
Yeah.
And here's what's very interesting. So mark the calendar. David said it today.
All right, hold on.
Write it down,
I'm writing it down right now.
This is it. It's starting right now because we've started to see an uptick.
I got it.
In inbound calls from our sellers.
Okay.
So instead of outbound and marketing, we're starting to come
inbound calls.
Inbound because they know that we're buyers.
Yeah.
They know that we're buyers.
Right.
So it's very interesting to see, the word on the street. Those guys buy. And now the sellers are getting uncomfortable. I had a call with, again, the gentleman from the family offices. And he said, what is your unique proposition, if you will? What separates your fund from other funds?
Yeah.
And we talked about this before. For us, it's purely the fact that I want to let all the big boys chase the 200 units and above. Let them go play in the sandbox.
Yeah.
We dial in the smaller unit base because we can turn that ship in a quicker period of time. They're also known as the guys that buy the stuff that the big boys buy.
Right.
So less of us.
It's a sweet spot.
It's a sweet spot. There are less of us in the smaller unit count than there are in the bigger unit count, which I find quite interesting.
Yeah.
But my investors get paid faster in the smaller unit count than they would potentially in a larger unit count because of the time it takes to turn the asset.
So we've talked about this probably many episodes ago, but let's talk about that sweet spot and how many units that is, just for all our new people that are watching. And what's that search ratio?
Yeah, let me pull up the famous buy box that sits on my desktop because I pull it up so many times a day. I'll tell you what our sweet spot is, or what we call buying criteria.
Buying criteria, yeah.
So I'll read it right off,
okay,
just for educational purposes, right?
Mm-hmm.
So location specifications, we want it near employment.
Yep.
We want it quality schools, access to retail, that might be changed a little. Access to restaurants, that might be changed a little as well.
Yeah.
So access to the things that people are looking for. Visibility from heavy traffic roadways. Now you got to remember, in Florida, heavy traffic roadways, that's okay because the assets are so far back off of the road afterwards.
Okay.
But we that visual, obviously low crime, suburban, business friendly states. I had a guy bring me a fantastic deal with the numbers in California, but California can't ever evict a tenant. Right, same in Massachusetts.
Very true.
So states, right? We want states that are in our favor.
Right,
friendly.
right.
First economic base, positive current long-term job growth projected. So there's still, even with COVID will not be here at some point. We don't know when that is, but it will not be here in the future.
Right.
And when it is not, we're going to continue to see that migration down into the Florida market. And then proximity to MSA of 250,000 or more. So we like that 250,000 community
or more.
or more proximal to
Oh,
the major
what
hubs.
about the roof on that? Is it like 1 million, or you don't care? Is it 2 million? It doesn't.
No, I don't care what the number is
Okay.
as long as it fits the buy box.
Okay.
It's not price, right? It's based off of returns. Cost means nothing.
Mm-hmm.
Return means everything, right?
Yeah.
So the specific properties, B class or better,
Mm-hmm.
1990 vintage or newer. And then we're looking in that 20 to 100 units. I pop it over to 140, 160
Okay.
because I know with the verticals that we have in place, we can move those just as fast.
Mm-hmm.
We like to see 90% occupancies because I'm buying cash flow. And if we can find them with rents 10% below market value or market rate, that's an awesome opportunity for us.
Yeah.
And then on the core plus, which means upgrade, maybe upgrading the office space or the lease space
Yeah.
that's there. We change out signage, some nice exterior stuff,
Mm-hmm.
amenities. The pool. One of the properties we have right now, it's crazy. In Florida, the owner thought it was a brilliant idea to fill in the pool in a 92 unit complex.
What?
Yeah, yeah, genius. So things like that. That's an immediate
Wow.
bing for us as we put the pool back in.
Yeah. Yeah.
Floor, cabinetry, backsplash paint, that kind of stuff.
Right. Right.
That's what we look for. And then when we analyze numbers at targeted returns for our investors, that's the quarterly distributions,
Mm-hmm.
we target 12% plus. I always dial that back because I'm the most conservative son of a gun. When I talk to a potential investor, I tell them 8 to 12.
Okay.
But track record in prior acquisitions and executions have been in that 12 plus range.
And that's throughout.
And
Let's dive into that a little bit. Is that any preferred rate, or is that any just potential?
that's our targeted quarterly distributions throughout the life of an investor's capital working in the fund.
Oh, okay. Okay.
And that is a 6-year. So you got to remember, this fund is what's called illiquid.
Mm-hmm.
Means it's not money in, money out because I changed my mind, I don't like it anymore.
Right. Right.
We don't play that game. This is for intelligent, grown up,
Yep.
qualified, accredited investors who understand the strategy.
Right.
Right. And then when we liquidate the fund and all of the assets inside of it after that 6-year period, so 1 year to turn it, 5 years to grow it,
Mm-hmm.
then sell it.
Right. Yeah.
And then at the point of sale, they participate obviously in all the equity that's been created over the life of that fund.
Mm-hmm.
And they're coming out with targeted 20% plus return.
Yeah.
So that's kind of like the big picture or the buy box, if you will.
Yeah.
That a lot of our realtors that are out there beating the bushes for us are looking for.
Yeah. Which those are great numbers considering current market, right? If you look at
Right.
one, the volatility of a market, right, in the stock market, but if you look at other like REITs or anything that's real estate related, they're a lot lower.
Yeah.
They're
Right.
a lot lower. You
understand, by the way, seeing as you bring up a REIT.
Yeah.
I had this conversation the other day, and again, I have to remember that not everybody knows what we know as competent investors.
So I know
make
that's
assumptions.
It's so true.
And it's bitten me in the ass so many times.
I know.
But they're like, well, why didn't you tell me that sooner? And I'm like, I thought you knew that, stupid. Come
Yeah.
on now.
Yeah.
It's not common knowledge, and I forget that it is.
Yeah.
A REIT that is traded publicly, like a publicly traded REIT on the stock market.
Right.
It's not valued by the sticks and bricks.
Mm-mm.
There is not a correlation between the value of the sticks and bricks in the REIT
Correct.
and the actual REIT itself.
That's right.
And here's the other thing that blew me away.
Yeah.
I can put in $100,000 in a REIT. Nathan can put in $100,000 in a REIT. The managers of that publicly traded REIT can pay me my returns with Nathan's money if they choose to.
Yeah. Oh, yeah. Of course. Yeah.
They don't even have to pay it off of the cash flow, off of the true value of the asset.
No.
This guy's like, oh, I got a REIT. It's brilliant. I'm like, yeah, until it's not.
Yeah.
Until it's upside down because it's not valued on sticks and bricks.
Yeah.
Whereas everything that we do as a private equity fund,
Right.
we're real estate trust.
Still real estate. Yeah.
Fund, we all, like I invest in the fund alongside my investors, we all win because we buy everything based off of the value of the building. which that's what gives the security of it all.
Yeah, and I want to add to that point because, like, I like to bring up the questions of people who don't know. So that's why I like to throw in some of these questions that when you say you're all in, right? When you're in it as well, you're in it. That a lot of people don't understand that when brokers are pushing or selling a REIT, that doesn't mean they're in it. They've organized it, they've created it, but that doesn't mean they're in it. They're managing it. So,
Yeah.
but that doesn't mean they're in it, and that's really the difference. That's why we've kind of mentioned this. Your fund, it's like a partnership. It's something that you're going in together,
Exactly that.
Yeah,
It's exactly that.
and that's why relationships are really strong. Otherwise, if you were just proposing a REIT, you don't even need a relationship. You just say, "Hey, this is the opportunity. Bring us your money." But you're looking for very strategic partnerships for people who like, trust, and appreciate what you're doing, and that can move forward and earn some great returns.
Yeah. Look, when we run all of our projections and our business models based off of today's activity and then going forward. So I don't buy on a pro forma, but I got to have a pro forma for my own fund so I know where I want to drive the ship. Right. And I don't know whether people are familiar with what are called the multiples. So when we run all our numbers, we flesh out at a targeted anywhere between a 2.4 and a 2.8. And what that basically means is for every $1 that an investor puts in, 6 years later, they get that $1 back plus another $2.80 on a 2.8. That's how we target it out. So when you use what we know as the rule of 72, right? How long does it take to double your money?
Yep.
Right? The rule of 72 says you take the interest rate at which you earn and divide that by 72 years, and that will tell you how long it takes to get by 72, and that will tell you how many years it takes to get you to double your money.
Yeah.
So when we're looking at that kind of a multiplier with 20% targeted IRRs, it's 3-4 years big picture to double your money, and that's why you get the extra 80 cents, if you will, afterwards. You know what I mean? Because we've got that capital for a little while longer.
Yeah.
So the stock market is going to just drive you up and down, and some people are okay with that, and that's great. And then other people look for smarter investors like us who can offer alternative investments.
And this is, and that's actually, I was going to just transition to that because this is an alternative investment. It's a less volatile, it's a more, as you like to say, sticks and bricks, right? Sticks and bricks. And it's something that you don't have to worry about so much. You can just set it and forget it. You just you make the investment and you just let the thing go. And then, we've talked about this before about communication, the fund being communicative of what's going on, maybe any developments along the way.
You've got to stay engaged, man. You got to get. It's set it and forget it. But watch this. How cool is it when one of our investors, I don't know, maybe they're playing a foursome on the weekend. You know what I mean? They're hitting that little white ball around and doing their thing, and they're chatting with their friends while they're going around. Yeah. And they say, "So what do you got going on?" "Oh, I'm in Freedom Venture Investments." "Yeah, what's that?" "Well, it's a private equity real estate fund. I own shares in the company."
Yeah.
You should see the last one we just took. All of a sudden it's a we.
Yeah.
Right? Because we let them, obviously we share in the excitement of taking down these assets. Right? How cool would it feel? How good would you feel? How secure would you feel if you knew that you were a 5% or a 10% or even a 1% owner in $100 million fund?
Exactly.
That owned, $750 million worth of real estate because of their leverage position.
Put that on your CV.
Boom. Like that. Or as they said in Goodwill Hunting, how do you like them apples? So,
if you want to boost your LinkedIn profile,
click here to smash something. That's YouTube. But on a serious matter, it allows my investors to sleep at night.
Yeah.
It really does. The value of a company, i.e. a stock, it can't go to zero, baby.
Right.
Just ask the guys who were invested in Enron, right?
Yeah.
take a look at all of those companies, look at what's going on with the malls and all that stuff now. So, those companies can go to zero, but the value of a piece of real estate, sticks and bricks, it won't ever go to zero. Can it go down? Yeah, but only if it's not designed to receive cash flow.
Yeah,
and that's the
historically, I think it was 1950s. Anyone can fact check this, but I believe in the 1950s, Dave, that a house in Massachusetts was $5,000. The average house.
It could have been.
Yeah,
it could have.
And I was like, that's crazy. And so the value of real estate always goes up.
Hold on a minute. In 2008, you could buy a house in Ohio for $3,000. All my Ohio friends are going, asshole.
Yeah, and you can still buy houses for $5,000 in Michigan.
Yeah, you can. Just don't drink the water. Yeah, there are still some pockets in Michigan that you can still pick up. Heck, not even Michigan. Let's not go too far. Well, not too far, but there's a place in North Carolina called no, I forgot the name. Rocky Mount. I thought it's called it's called Shitesville. Isn't that it? Shitesville in Raleigh?
I'm not sure. That might be a place also. But no, listen, there's a whole town.
You didn't get it.
No, I missed that.
Shitesville.
Shitesville. I thought so. I wasn't sure if that's exactly where you're going. I was like, is there really a place called that in North Carolina?
Probably. There's a place called Toad Suck Ferry, Arkansas.
No, there isn't.
Yeah, there is. Google that shit. Toad Suck, TOADSUCK, Arkansas.
Oh my gosh.
Who's your daddy? Hello?
What is this?
Hello. Thank you very much. I'm here every Thursday night trying to be Told you. I don't know how much a house is there, but you can buy a house in Toad Suck Ferry, Arkansas.
Oh my goodness. That's crazy. I never heard of such a place.
All right. So as we were saying, the value of sticks and bricks of the physical asset.
Right.
It just becomes, especially with all of this fear in the marketplace, right? So now I can get in a position where I can ride out the storm. If somebody is seriously concerned, and I think they are, about protecting their principal, right? Losing what they have, because they will. The tax man will take it. Yeah. Inflation will take it.
Yeah.
The volatility in the marketplace will take it. But if they have that fear of losing what they have, that coupled with not getting the retirement that they want or the legacy that they want, now is no better time than multifamily commercial investing to hedge against those losses.
Yeah. So I got some stats for you.
I like stats.
This is some stats. And I'm just going to go to Massachusetts because that's where we're from. So, I was from. You're there. I'm from there. But anyway.
Well, I'm actually from England and I live here, but that's all right.
Yeah, it's all right. It's all right. You're just coming back. You're coming back to do the tax on the tea, right?
Okay. Yeah, that's right. Tea in the harbor. In the harbor.
So the median, not the lowest. I think what I read one time was the lowest was $5,000. Anyway, median price in the 1940s was $39,000.
Yeah.
1980s, $95,000.
I lost the 1940s value on the craps table in Vegas once.
I mean, when we're looking at some of these numbers, I mean, it goes over every state from the 40s, the 80s, and the year 2000. I mean, all of them look like a Minnesota, $70,000 increase, right? And over all these years. So yeah, real estate always goes up over time. Always goes up.
Yeah, it does.
Like Everett is saying here, well, the sticks and bricks can eventually go to zero if the project is bankrupt. Investment goes to zero. Ask me how I know.
Hey, Everett, I get it, buddy. I get it. That's why we make our money when we buy. we realize our profits at the time of resale, refinance, or sale. No, I get it, man.
Yeah, and that goes back. I think Everett. I remember Everett was investing during right before the height of the market, right? And he ended up in a really bad situation, like many other people were. And going back to what we were talking about earlier about bankruptcies, right? There is opportunities. That's the opportunities. Sometimes if it's too good, it's too easy. Like the way people are getting credit right now is very simply. My buddy was telling me earlier today, he literally went on his phone, tapped a few buttons, and got over $10,000 of credit instantly. Okay?
Oh, sure.
Like right now.
Sure.
Yeah. So there is more credit in the marketplace than there ever has been. And more cash or digital money in the marketplace than there ever has been. And that's just a reflection of a few years ago, however many years ago, 12 years ago.
Sure.
So the opportunity of when you're buying real estate has to be a bad situation, right? If you want to get a great deal, whether it's a motivated seller, bankruptcies, foreclosures, and that's the best way to buy it. That's the best way to buy it.
I was at dinner the other night with an investor, his sons, and actually my GC, and we were just banging around some real estate ideas. Yeah, and it's like, I'm gonna say it again. If you're following any house flipping ideas right now, I just be careful, dear Lord. I talked to a guy from Arizona who is dialed in with a company that buys reverse mortgage assets. Okay. So the reverse mortgage is, in my opinion, predatory. So you've got these assets, but now what they're doing is the bank needs to liquidate them. They thought they'd take them back at top dollar. Well, nobody's buying them at top dollar retail. So this guy's got assets that he can legitimately sell to an investor at 50 cents on the dollar. So if the house is worth $1 million, you can buy it for 500. Right. Put 100 into it for 6, sell it for 8, 850. You're still in the game. But we were talking at dinner the other night. These single family, like I watch all of this shit that comes down on Facebook and Twitter and Instagram and Auntie Mary Graham, whatever the hell is out there, and it's like all of these like catchy one-liners to get somebody to spend money on stupidity, because it's not there. Right. The single-family flip market isn't there unless you've already been in the game for 5-10 years and you've got all of the resources to execute. You know what I mean? Yeah. So for me, they say, what do you mean you're going to buy it? You're the flipping guy from Flipping Boston. No, stupid. I'm the guy who's never lost a dime in real estate since he got educated. That's who I am. Identify me as that. Right? Smack up the side of the head. Yeah. So again, stop being stupid. Use some common sense, right? It's the same concepts we've been talking about. If you are not buying yourself cash flow, you're setting yourself up to lose. Yeah. And, to Everett's point, I feel you, buddy. I got hurt by real estate before I got educated with real estate. And, herd mentality is the biggest marketing tool the human race has ever devised to use. For massive negativity, right? And herd mentality can be used for positivity if we all learn to get along, if we all take care of each other. If the herd can do it, it's a good thing. Sure. But the herd seems to go running towards cars, boats, and leather coats rather than common sense.
Boats and leather coats. I like that.
Shiny shit. Look at this.
Yeah.
It's going to make you a millionaire.
Right.
Let's do that.
The battle, the human nature battle. It's
the human condition.
The human condition. It's so true. Interesting.
Yeah, I get it.
Good stuff. Well, you shared a lot of good stuff today also about what the fund holds for real estate, which is really enlightening. I think, especially to some of our people that are following along. Eric says, "Hey, Dave. When's the party?" Eric. Just so you know, when's the party? I don't know. Is there a party going on? You guys having a party?
That's some email marketing going out. I don't know what the hell it's. I'm getting people asking me, "Yeah, I'll take one," and I'm like, "Take one what?" I don't know what. We're still trying to figure out the marketing side. So if you're getting emails from me, hold tight. There's always a pot of gold at the end of David's rainbow.
It's random. Yeah. Have you ever dressed up as a leprechaun before?
That's a very personal question. Have you ever dressed up as a woman?
No.
I have, on national TV.
No, you haven't.
That was beautiful. Yeah, oh yeah. There's an episode of Flipping Boston where we dressed up as
Really?
the
I'm
opposite
Flipping
sex.
Boston?
We walked through downtown
What?
Salem. I'm not sure what one it was. It might have been.
That had to be like 12 or
episode
13.
6 or 7,
Really?
something like that. Yeah.
Oh,
yeah. Check it out.
I'll
Amazon Prime.
I'll check it out.
Jeff Bezos paid so much money for that show now. It's unbelievable.
Oh, unbelievable. Unbelievable.
I'm going to get it for sure.
Oh, goodness. Well, Dave, it's been fun. Very informative session episode today, for sure.
Thanks, brother. Appreciate you.
Eric is saying when he was talking about the cocaine, where is the party? That's a whole other show.
That's a different show. That's when we do the 12 steps of recovery.
Yeah.
I'll call you in on that one later.
Good stuff, Dave. Thanks everybody for tuning in today to the Cash Flow Show. We'll see you next week. Same time, same place. See ya.
Take care.